banking space that is in focus in today's trading session. On back of the fact that you have the RBI guidelines coming in on LCR, you have Rikin Shah, who is the Senior Vice President at IIFL Capital, joining us right now. Very good morning to you, Rikin. Thank you so much for joining us on ET Now. I wanted to understand the significance of this sort of a move coming in, given the fact that the norms look, or rather, are much less, or rather, they are less tighter than what was expected.
Yeah, morning, Cheryl. So you're right that the final guidelines on LCR are significantly watered down. And in fact, vis-a-vis the draft circular, if the draft circular was implemented, we had estimated the LCR hit of 10 to 15 percentage point for the individual banks. But now in the new final guidelines, there is some watering down, and I'll get into more details on that in a moment. But the final impact is actually positive benefit of 6 percentage point for LCR for the entire banking system. It can result also in higher credit growth up to the tune of 2.5 to 3 lakh crore, which is 1.5% of banking system, and PAT benefit of anywhere between 1 to 4% for individual banks.
Rikin, good morning. This is Shrishti also joining in. So believe that this move is not just expected to boost the liquidity, but also improve the margins of the company. But given the structure of the bank, Rikin, help us and also highlight some of the banks which could be the biggest beneficiary of this move coming in.
Sure. So just to step back, what are the key changes vis-a-vis the draft circular? The two key changes are in the draft circular, the runoff factor for retail deposits was going to increase by 5 percentage point for deposits which were enabled with digital facilities. In the final circular, it has been brought down to increase of only 2.5 percentage point. So that's one big change. And the second change is the deposits of funds kept by various non-financial corporates, which includes trust, proprietor companies, AOPs, etc. The runoff factor earlier used to be 100%. Now that has been brought down to only 40%. The effect of this is that the LCR goes up. In other words, the banks will have to park lower number or lower amount of security, lower amount of their funds in government securities, and they can instead use these funds to deploy in the loans. And that is where the loans typically are yielding 200 to 300 basis points higher than the investment yields, and which is why the margins can improve anywhere between 1 to 18 basis points for banks under our coverage, and the PAT impact can be anywhere between 1 to 4%. Now, within this construct, the banks where we expect the benefit to be relatively more are the ones who have higher proportion of this non-financial corporate deposits, because that is where the runoff rate has come down from 100 to 40%. And the banks which qualify in this will be the likes of RBL, Federal, Kotak, HDFC and Bank of Baroda. So these five banks will see relatively more benefit from this final LCR guideline. On the other hand, someone like ICICI Bank is unlikely to see any meaningful upside from the current guidelines.
So have you done any back of the envelope calculation on what sort of impact will have on their NIMs or PAT of the banks that are likely to benefit the most?
Sure. So for the 4-5 names that I mentioned, which is again to recap, Federal, RBL, Kotak, HDFC, and Bank of Baroda, the margins can anywhere improve from 5 to 18 basis points for them, and the PAT can improve anywhere between 1.5 to 4%. RBL is an outlier where the PAT impact, the PAT benefit can be as high as 12-13% as well.
Rikin, that's so great to have your views on this whole news flow, but I just wanted to take this discussion forward and understand from you what's been happening and what the investor interest is looking like, specifically in the banking space, because no doubt on the index front, it's Nifty Bank that is seen to be hitting its all-time high levels, and this particular news has given more fuel to the particular rally. But till date, Rikin, the news flow around has been positive with the private names. Do you believe that in some time from now, maybe it's the public sector banks as well, which will catch up the rally? Is the investor interest with respect to outlook, valuation coming in this pocket as well?
Sure. So the key difference why the banking sector has been doing relatively well vis-a-vis other sectors is the flight to safety for domestic investors. Given the significant earnings downgrade and very elevated valuations in other sectors, in that context, banks were very inexpensive. and hence in the flight to safety, the banking sector did relatively better in last few months. Further to add to this, in the last few weeks, we have seen the FII flows also turning positive. And typically, we have seen that whenever the FII inflow or outflow happens, a large part of that is usually deployed or funded via the bank. So even that is helping the banking sector. Now, given where we are today, after the outperformance seen especially by the large private banks, we think for next couple of quarters, the larger private banks can take a breather because the earnings growth in FY26 is likely to be only low single digit. This is primarily because now we are expecting 100 basis point of repo rate cut cycle cumulatively in this cycle, and that will impact the bank's margins in FY26. Of course, a lot of that gets reversed in FY27, but given that FY26 earnings growth is going to be only low single digit for larger private banks, we think that after the recent rally, they can take a breather for a couple of quarters. The PSU banks, we are recommending, of course, the likes of SBI, Bank of Baroda, etc., have also been doing relatively good. We are recommending to use the ongoing rally to trim into the PSU banks and then move into the larger private banks in second half of FY26. But in the near term, we see some upside in the mid-sized banks. They are seeing some turnaround in terms of their asset quality in MFI exposure. Earnings growth is rebounding, and the margin hit due to repo rate cut is going to be lower for them. And given that they have underperformed significantly in last 1-2 years, and even after the recent rally, the valuations are very cheap. Some mid-sized banks can look attractive in the near term.
Right, you said about the mid-tier banks that will look attractive in the near term. But Rikin, I just wanted to understand and get a sense from you, given the fact that the banking sector also in between was actually plagued with the fact that we weren't seeing a lot of deposits actually coming in for the banking space. And that was kind of a cause of a worry in between. Do you think that sort of issue has now been resolved, and also the exposure to the unsecured segment?
So two parts to your question. The first one is on deposits. So currently the system loan growth is around 11% and deposit growth is around 10%. With the liquidity easing measures that the RBI has been taking in the last few months, they have injected almost 7 trillion of durable liquidity, and the governor has committed to almost 2.5 to 3 lakh crore of to maintain liquidity surplus in the system. That rather than helping the deposit growth, it actually helps in bringing down the cost of deposits. So what we have seen is that the wholesale deposit rates have cooled off by 80-90 basis points already. Banks have taken SAR rate cuts anywhere between 25 to 200 basis points. And even the retail term deposit rates have been cut by 10 to 30 basis points. So the excess liquidity is actually helping the banks to take faster cuts on the deposit and absorb some of the hit that would otherwise have come only from lower yields due to the repo rate cut. On the second part to your question, which is the unsecured loans, we had written a report a couple of months ago where we analyzed the bureau data, and we had said that in personal loan and credit card segment, while the NPAs are still moving up, the early bucket delinquencies, which is loans which are 1 to 90 DPD delinquent, that trend has started to improve, which means that even the unsecured loan growth peak stress should now start stabilizing and improve probably a few quarters down the line. And likewise, even for MFI, we would see peak of slippages in 1Q FY, 4Q FY25 or 1Q FY26, and credit cost would peak out in 1H FY26. So net unsecured loans asset quality outlook is looking better than what we feared 6 months ago, and will directionally get better and stable in the next
Right,
few quarters.
absolutely. Point taken, Rikin, and looks like a lot of confluence of factors actually working in favor of the banking space right now. But thank you so much for taking time out. It was a busy day for you, I'm sure about that. And thank you for joining us and explaining the developments for the banking space. But talking about banking space,